Well, hello everyone. Welcome to Payne's Education. This is our Wednesday beginner intermediate class. My name's Gary Edmonds. Glad to be on board with you today as I have been the one who has basically taken this class for the quarter, right? We basically have a series of topics that we will discuss in this beginner intermediate class, and it kind of goes along and coincides with the online material and the things that you're going through as you go through the different steps that we have there. So we're actually wrapping up this series. Next week will be the last one for this series and for this um, quarter. Before in January we will switch to a new instructor. I believe Rob will be doing the beginner intermediate classes, and I'll move over to the intermediate advanced classes and switch off with Greg Edwards on that one. I believe that's what it is, but yeah, we'll see what's going on with that a little bit later. But for today, let's get moving forward of what we're going to be going over and talking about today. But let's go through our disclosures. Remember, this presentation is for educational and informational purposes only. All investments involve risk, and past performance of anything in the market does not guarantee future results. Unstoppable Prosperity and Charles Payne are not giving investment, tax, legal, or other professional advice. No one associated with Payne's Education are licensed, so we cannot and do not give recommendations to buy or sell anything. Unstoppable Prosperity retains all titles, interests, and intellectual property rights of the material provided and may not be used without express written consent. The terms Unstoppable Prosperity, Payne's Education, Wall Street Strategies, and other marks and logos displayed on its websites or other communications may not be used without express written consent. Charles Payne's experiences are not typical. His results are not a guarantee of your success. Unstoppable Prosperity is not endorsed by or affiliated with Fox Business. Making Money with Charles Payne is the property of Fox News Network, LLC. All right. So, folks, there's me. Okay. Most of you know who I am. I do know that we are getting more newer students to come in. That's fantastic. Glad to have you on board. And get a little bit more comfortable with what it is that you are trying to do. But our agenda for today, we're going to go over a topic that a lot of people really don't think about, and this is a topic that can have a big impact on our success as a trader or not, just depending on how we are looking at ourselves and doing our trading. So we're going to be going over some behavioral analysis. Okay. We'll talk about trading psychology. We'll also talk about the biases with it, and then we'll go over and talk about some common mistakes with it. But before we do jump in full, with both feet into our topic for today, I'm just going to go ahead and, for those of you who are a little bit newer to the program, to Payne's Education, and again, right, as I mentioned just right at the beginning of class, we go through a series of each quarter in the beginner intermediate, and we kind of go along the lines that coincide with the stock investing foundation lessons. And so we'll kind of go through all the information right through there as we get moving forward. So if you're just joining out, don't worry about it. You're not behind. If you don't understand things that we might be going over, do not worry about that. You can get caught up in it. As I mentioned, in January, we'll be starting the series over again with a new instructor. But if you wanted to, before then and have some time to do it, especially with the holidays coming up, sometimes we get a little bit short on time. You can go to the Stock Investing Live classes and the beginner intermediate class here, and then you can just kind of scroll down and kind of take it from the beginning, right? And go through some of these recordings to help you get up to speed if you wanted to go ahead and do that. So again, that was in the quick links. Stock Investing Live classes, beginner intermediate class, to go ahead and do that. Now let's do this. I'm going to go ahead and pull up the Thinkorswim Paper Money platform. Again, folks, this is something that we use in our class. On all of our classes, all the instructors, we do use this. It's not because we are endorsing or affiliated with any broker. You can choose whomever you want. We just use the Paper Money platform in our classes just to make our presentations more uniform and things along that line. So what I wanted to do really quick before we do jump in and get our topic today is just kind of go back and do a little of um, uh, um, um, some management of some of the trades that we've been doing in this class and get a little bit more up to date. Market is, yeah, it's just kind of hanging out a little bit, right? This is the SPY, the spider, tracking the S&P 500. Not up a whole lot, right? It's just kind of hanging out. I think all the market's doing that until the Fed comes out and announces what they decided to do and moving forward with the Fed rate and things like that, and kind of the projections moving forward. So I think the market's just kind of hanging tight, and we'll see maybe some movement after after they do announce later on today. So that's 2 p.m. Eastern time that they do announce. So yeah, everything's just kind of hanging out there a little bit. But let's go back to our monitor tab here. Let's take a peek at some of the positions that we have going on. Now, we did have something that closed last week. Okay, and so if we wanted to get a little bit more onto this one, we're going to go up to the account statement, because obviously if it closes, not on our positions anymore. So I'll go to the account statement, and I'm just going to go back. Well, let's just do 30 days. Why not? Okay. Now, if I go to trade history here, we'll notice and see that we did have a stock that closed out kind of in the beginning of the day on the 6th of December, which actually was last Wednesday. And we saw that we did EAT. Now we sold that for $39. We actually got into this just the week before, if you may recall, on the last Wednesday of the month of November. We got into it. So we basically got in at 35.93. We sold for $39. If you might remember, we did this as a what? As a kind of a swing type of a trade. And so we go to the chart, we'll pull it up, EAT here, EAT, and here we go. Now it shows you the buy and the sell on the chart. So we hit our target, we hit our profit that we were looking for, and so it was a swing trade, very short term, and it worked out. We did have our OCO order on there, meaning that we had an order to sell for a profit, or we had an order to sell if it went down and we lost money. Okay, so just kind of showing you that on that one. But let's go back to our monitor tab, because we do have a couple positions that we put in this class that we're still tracking, we're still going. So TXN is one of them, right? So I'm going to click on our little note here. So we bought this on November 29th as well. So it was, again, a swing trade. So this is one of the advantages of making a note, so you can kind of remember what you're doing there. So we did a swing trade. So we had a target of 163 and we had a stop of 149.45. So if let me kind of move this down a little bit, and we'll look at this on the chart real quick, but we have a target, again, 163 and a stop at 149. Well, we did get into this trade at 154.32, and currently the stock is trading at 159.90. So it hasn't really gotten to any point. It hasn't gotten to our target yet, or it hasn't gotten to our stop yet. So it's still working for us. And let me go ahead and pull it up on the chart here really quick. And as we look at it now, again, so here's where we got into it at 154.32. And just showing again our stop and our target that's linked together with that OCO. We put that cursor on there, and it shows us that target of 163, and it shows us the stop of 151. Okay, so we basically have a $3 loss, a little more than a $3 loss, with a potential a little bit under $9 target. So it's almost a 3-to-1 reward to risk on here. So folks, I'm going to ask you this: if you were looking at this trade and you're doing this trade, and as we should on a daily basis, kind of see what's going on, any reason to do anything different with this trade right now? Any reason to get out? Any reason to just say, okay, let's take it, or anything else along that line? Okay. Well, no, but right, because we already have our rules in place, right? We already have a target in place. We already have a stop in place. Now, it could be that at this point in time, if it moves up, we talked about a little bit about this last week, kind of moving some stops up. I don't think we're in a scenario situation right now where we would be doing that, but we'll just hold on to it and let it work a little bit more for us. Okay, so let's go back to our monitor page, and the other one we're going to look at will be ZS. And we'll pull this one up here. Go scroll this down a little bit here. So again, we placed this trade on 12.6. So we had a trade profit target of 223 and a stop of 191. So we got in at 203.56 there, and it's currently trading at 211.91. So again, it hasn't gotten to our target. It has not gotten to our stop. And so if we're going to take a look at this, I'll pull it up on the chart and we'll just take a quick peek at it. Oh, we've got a lot of information. In fact, one of the things that we did, we kind of confirmed a little bit last week when we did the trade of a target based off of a fib, and we also did it based off of, I think, a flag or something else along that line. Maybe I should have put that in the notes, but we can see on the chart already we do have, that Fibonacci right there, and our target again about 223. With our stop right there at 191, we got in at 203. So yeah, we have our trade in place, and so anything, I'm going to zoom in a little bit closer maybe so we can see it. So anything different that we'd be doing is it's moving in the direction we want it to. So anything that we should do at this point in time, folks? Remember, it's we have our target, we have our stop, we just let it work, right? Yeah, so we just let that thing continue to work and hold and watch, play on. I like those comments on there. All right, so again, our monitoring of our trade, our management of a trade, nothing to do. Okay, so there we go. Just thought I'd throw those out there to you really quick. And before we do jump in for our topic for today, so let's go back to our slides here, folks. And again, so the behavioral analysis. Okay, so Randy asks, would you pay attention to the news about the company when considering action? Well, so let me go back to the page here. So you certainly could, watch the news, look at the news if you wanted to, but guess what? A lot of times news is noise. Meaning it doesn't, a lot of times doesn't affect the stock. Now, there will be news events that will affect the stock, but a lot of times, sometimes people just kind of, well, hey, I've got to write a news story. Let's write about the company type of a thing. So how do we tell if news is going to be a big issue or a driver? Look at how the market reacts to the news. If there's no reaction, the market says it's no big deal, or at least it's news that they've already considered and causing the stock to continue to move in its way. But if it's news that will affect it, then obviously the market thinks it'll affect it. You will see that reaction in the trade on the stock, whether big move up, big move down. So be careful that what you do, and in fact we'll get into this a little bit today, that you are putting an emphasis on something that the market isn't, as far as a particular news story. Okay, so but that's good questions, but again, that kind of ties in with what we're going over today. So let's talk about this. Now, this is going to be a little bit different type of a scenario of a class, so to speak, but it's going to be a good one. I promise you, folks, especially with you newer folks and trying to get a little bit better feel for it. Now, we have the weighted combinations of, Charles talks about this with the trading. That'll be kind of more along the lines of the swing trades and things like that, and the buy and hold, right? So these things are basically kind of mirror images of each other almost. Technical analysis is very heavily focused on with the trading part of it, very short-term trading, buy and hold. The fundamental is a heavy aspect of it as well. But we do have a portion of the other pillars, of the three pillars. But again, just because sometimes the behavioral pillar doesn't appear to be that well weighted, heavily weighted, it can be one of the biggest things that can affect our trading. Because behavioral, I kind of look at this into two scenarios. Okay, the two scenarios are the behavior of the market. We're looking at the charts and we're seeing the market and what's going on. Okay, we're trying to understand their behavior on whether it's the market, whether it's a particular stock, but the chart tells us so much about their behavior based off of technical indicators, technical aspects, technical points of entries and exits and things along that line. So that's one part of it. And so sometimes we can kind of lump that into the technical analysis side of things. But the other part is what we'll be going over today is your behavioral pillar, who you are as a trader, how you will act and react when you see things happen on positions that you are holding or see things happen on positions that you may not be holding. Okay. And how we react to it can have a huge impact on the success of our strategies. Okay. Now, oh, there you go, Lynn. There you go. Gil said Lynn, LIN. Like yesterday, traders were betting that LIN would end up on the NASDAQ 100, so it shot up, but gave it all back today when it didn't make it in the hallowed halls. Yeah, and so that, I mean, that's a great point, right? We'll go ahead and pull that one up really quick. So LIN. There we go. Okay. Reaction, because people were betting on something to happen, news, and when it didn't happen, it gave it all back. Okay. Gave it all back. Okay. So it's kind of like, as Mark said, betting versus investing. Now, sometimes there's nothing wrong with betting. We call that speculation. Okay. But you have to still have some rules for speculative trading in that. So it didn't work out in that situation, but that's great, right? Fear of missing out, FOMOs, and then, yeah, it didn't happen. So I like that because it kind of fits into what we're going over talking about today. So what we're doing here, folks, let's go ahead and get into us, because I'm going to go over now. Some of you have been maybe students with us a little bit longer. You might be a little bit more familiar and with this and some of the things we're going to talk about. But again, it's always good for a review to help us remember things. So, folks, this is what we're going, and this is where we're getting into the behavioral, because our brains are incredible. I mean, if you sit there and you think about it, the things that you are able to do and lock in, and the things that it does for you, just everyday life, even when you're not thinking about it or realizing it, your brain is doing so many amazing things for you. Okay. But one of the things that the brain will do for us is it fills in blanks. Okay. When we are expecting to see something and we don't see it, then our brain will kind of fill it in, so we actually see something that we think we are seeing, that we're expecting to see, because all other, points and when we're trying to connect the dots, it will say, okay, logical conclusion, this is what I was expecting to see. Our brain fills that in. And it does it all the time for us. Okay. Now, yeah, hoofbeats equal horses, not zebras, type of a thing. Yep, our biases fill the gaps. Yeah, absolutely. Mark says cognitive dissonance always needs resolution. Yeah, it does, right? Because we don't like to have things just hanging out there. And this is one of the reasons, folks, that whenever we place a trade and we bring up the trade confirmation box, what do I always say that you need to do when you have that trade confirmation box before you hit that button to send the trade off. I always tell you to read it and read it out loud, because your brain might fill in something that you're expecting to be there that is not. Okay, so that's just kind of one example there. But it also allows us to have hypoglycemia. Okay, who knows what this word means? Hypoglycemia. Kind of a big old fancy word here, right? I'm putting on my little doctorate coat here and putting it up. It's a made up word, isn't it? And low sugar, said Mark. Okay. Low typing skills, maybe fat fingered a little bit here. Okay. It's not having anything to do with blood sugar or anything else along that line. So I'm going to ask you this. I'm going to put something up here, a sentence, and I want to know how many of you can read this sentence. What does this sentence say? Okay. Yes, a lot of people are saying yes. I hope so, because again, this is what our brain is doing. Our brain is filling in the blanks and helping us to recognize what this sentence means. And so what does this sentence mean? You can read this. Well, let me point this out. Okay. You can read this even with all the words a total mess. There you go. Some of you started typing that in and saying easy to read. Okay. You know what? So there's a study that says if you have a word, and as long as the first letter and the last letter are where they're supposed to be, all the other letters in there can be mixed up. And you can still understand it. You can still read it. And Steve says, I type just like this. Yeah, so do I. That's why I could read it. Okay. So this is what our brain is doing for us here. Okay. It's filling in the it's filling in the blanks for us. So it also makes us see things that aren't there because we want it to be there, kind of like that example I said about the trading. And the when you bring up the trade screen and the confirmation box. But again, right, if you want to see something there, maybe you're out in the wilderness or just doing you're watching TV or whatever it is it might be, but you are expecting something to be there, and then how many times do we think that we see something there? Okay. Yeah, so it does that for us. It kind of fills in those blanks for us. But we're going to play a little game here, if you're okay with this today. So I know some of you probably see some different things, or maybe some of you have seen this before, some of these pictures, but we're going to play the game. What do you see? Okay. Jim says, I saw Bigfoot. Was that true or is that a fake? Did you see a fake Bigfoot, or did you see a real Bigfoot, or did you just see something that you wanted to see, right? And you just said yes. Okay. Do you see what I see? It's kind of a Christmas theme there. That's a Christmas song. What do you see? Okay. What do we see? Do you see an old woman? Or, okay, I'm seeing some of you say a young girl or a young woman. Okay. So, how many of you only can see one? How many of you can only see one? Okay, some of you are saying both. I said a lot of you are saying both. One. I see two. Okay. Well, let's see what happens. What about the old woman? There's the nose of the old woman. Okay, when you think of a kind of an old woman and along in years, right? There's the mouth and the chin. Okay. And there's the eye of the old woman. And the old woman is kind of looking in this direction. Okay. Kind of looking in that direction. So nose. Yeah, there's the nose. Maybe it'll be a little bit better if they put a wart on it or something. There's the mouth. There's the chin of the old woman. Okay. Now, what about the young woman? Oh, there we go. Actually, I took the picture out of it. Okay, took the picture out of it. There's the profile of the old woman. Does that kind of help bring it in? For those of you who couldn't see the old woman, does that kind of bring that in a little bit better perspective for you, the old woman? Okay. Randy says no. Okay, that's fine. That's fine. So see, here's the eye, there's the nose, there's the mouth, there's the chin. Okay. There it is. Now the young woman, if you saw the young woman, so here we go, same type of a thing. Well, that's still the nose, but it's a little tiny nose right there. This whole thing isn't the nose. This is the young woman's chin. Instead of the chin being down here, right? This is the young woman's chin. And so what are some of these other things that we saw on the older woman, that now how they do relate to the younger woman? There's the younger woman's ear. And then there is kind of like a necklace or a choker that the young woman is wearing. Okay. And so the young woman, she's looking off into this direction. So we're kind of standing behind her, seeing kind of the backside of her face. So Greg says, I saw the young woman immediately, but not the old one. Okay. So what do we see? Okay, is it a right one or a wrong one? No, there's not. But again, this is what our brain is doing. Our brain, maybe we come in here and something causes us to immediately think of one possibility, and then our brain fills in what we want to see because of that possibility. So in reality, right, if you saw the bonnet first and think, oh, well, young women wear bonnets, and you probably picked up the young woman. If you saw kind of that big old nose, then maybe you saw the old woman. Okay. So your brain picks up these clues that your eyes see and then fills in the blanks. All right, let's go on to another one. Oh, wait a minute. There's the drawing of the young woman. Okay, on there. Okay. See, I had to step back a bit to see the old woman. That's all right. Now, next one. What do you see? And D-Bot depends on the section you look at first. Absolutely. Whatever your brain picks up first starts now filling in everything else that your eyes are trying to focus on. Okay, so two people, two faces, and a tree. You see two girls, two people, and a dove. Five faces, six faces, or six people, faces in the water. Okay, so pretty interesting. How about two faces? So are we talking about, right, the faces here? Here's a face right here, right? Kind of looking this direction. There's a face right here, kind of looking this direction, kind of looking at each other. But then some of you are seeing some other faces, right? There's a face right there. There's a face right there. There's a face right here. There's a face right here. Ah, look at all those faces. Okay. Look at, and the bird. Here's the dove, right? Here's kind of the bird. There's the outline. There's the beak right there. There's the eye, the wings, right? There's the outline of the bird, of the dove. Okay. How many of you see, and some of you said this, a gnarled tree on a cliff? Yeah. So, okay, look at, there's the face. There's the face. What I kind of talked about. There's the gnarled tree on the cliff. But how many of you actually see, instead of a gnarled tree, some really weird statue of a woman with really weird arms? Right? Really weird statue. Okay. Because here's the body, and there's a leg right there, there's a leg right there, and the rest of the body. Here's her face and head, and really weird arms. Okay. Really weird arms. Yeah. So a lot of different things that we could potentially see in just that picture. Now, some of you saw a lot of things. Some of you saw one type of a thing. But again, what did our brain focus on? What did we see? Okay. From Stargate, there we go. Saw that first, says Miles. Good job. Now, next one. What do you see? How many of you see a woman's face? A horse face. Well, I'm sure she probably doesn't want to be called a horse face. That's not very nice. Although you could call like Carrie a horse face, right? But anyway, two horses. Okay, that's a horse face. Okay, or two horses fighting. Okay, and some of you or kissing. Okay, I like that Paul better. See, Paul had the nicer version of it, of two horses kissing. I went with two horses fighting. Okay, so again, here's the one horse, right, with the front legs right there. Okay, tail. There's the other horse on the other side, just almost a mirror image of it, the front legs and the tail. I mean, the front legs and the tail, and so on. So there's the two horses. We'll go kissing. I like that better. Okay, there's the kissing. The face, it's right inside in between. Okay, there we go. So in fact, the front legs and the hooves happen to be the eyebrows and the eyes of the lady, the girl. And the bird is the nose and the mountain range with the lips. And Carrie says, now you're causing me to wish I see something that isn't there. Okay. Horses discussing the market, Steve. That's funny. Okay. So, interesting stuff, right? Our brain is picking up and filling in things that we automatically think that we want to see. Next one. We don't have too many more here, but we're going to go over. So next one. Which orange ball is bigger? The one on the left? One of Gil says buffalo feces in that last picture. Um, Gil seeing a little home on the range there. So which orange ball is bigger, the one on the left or the one on the right? Okay. So a lot of you are saying same size. A lot of you are saying the right one looks bigger. All right, so let's see what goes on. Gonna put a line there. That's a straight line, folks. It really is. Put a line there. That's a straight line, folks. Those two orange balls are exactly the same size, but just with the perception now of the surrounding things to those balls, it causes us to think one thing that in reality is not correct. Okay. Behavioral. Okay. Can you now? Hopefully, we're starting to shed a little bit of light. Now, again, how is all this going to tie into our trading and things along that line? Again, this is an exercise of how we can be thinking we're seeing something that's not really going on because of perceptions that we want to project, perceptions that we have because of things that we read or hear. Okay, and D-Bot, you said that a little earlier. Again, that's why witnesses to accidents are unreliable. That's why you can have 5 people who saw the same thing, but they give completely different accounts. Exactly right. Except for me, I would never be unreliable as a witness because I see things exactly as they are. Okay, never mind. So let's go do another one. What do you see? It's about perspective, Mark, and exactly our preconceived ideas of what may have happened. A pelican? Okay. A seagull? A rabbit? Okay. A bird? So a duck? Okay, it could be a duck. Ducks have kind of a little bit more flatter bills, and so if you wanted to put it as a seagull, I guess you could. It's Superman. What about a rabbit? So where do we see these? Okay, this is the bill, or this is the beak of the bird. This is the head of the bird. Okay, so all we have is a head shot. This is the eye of the bird, and again, facing this direction. There is the bird, the duck, the seagull, whatever you want to call it. Now, what about the rabbit? Well, what happened to be the bill or the beak are now the ears of the rabbit. This is the eye of the rabbit facing this direction. This is kind of the little nose and the mouth right here, and kind of going back down along the neck. A rabbit, says Steve. It's exactly right. The rabbit. Go get that trademarked. AC Jack says, I see dinner. Well, regardless of what it is, whether it's the duck or the rabbit, both of them taste like chicken. So there. All right. One more. What do you see? A square? Or do you see 4 circles? A square or 4 circles? So square and 4 circles, 4 blue Pac-Men. I like that. Both of them, both square. Okay. Well, is there both, or what is it? Or is our brain telling us that one thing's there when in reality it's something else is causing that to appear? So, what about 4 pies with a slice taken out? How about blueberry pies? That's what we'll call those. Okay, so let's do this. Watch those circles, watch those pies, and see if your square really was a square. Was that square really a square? Or was the square just what our brain saw because of the placement of something else? Okay. The square was not there. So in reality, there's not a square, right? It's just something now that our brain perceives to be because of other things that are creating that in our minds. Pretty cool, right? Or you can say, okay, this is pretty boring. This doesn't help me at all with my trading. It does. Why does it do it? Okay, so let's go over some of the things that we're going to be talking about here. Gil says, I'm going to have to take a nap after the session. So basically, it's different for Gil because usually he takes a nap during these sessions instead of after. Okay. 6 myths of self-directed investing. Takes too much time. Okay, we don't do it. Investing takes too much of your time. Now, again, some of you are saying, well, believe me, that's so true. I'm getting into this and I didn't realize how much time I would have to spend going to classes and reading stuff and trying to, learn this and learn that. Well, guess what? It does take a little bit of time in the beginning, right? And as soon as you start to learn a little bit more, then the time invested in it is now based off of how much you want to spend on. But it doesn't take too much time. Again, as you're learning, it might take more time. Okay. Investing in the stock market is a form of gambling. Is that, but again, that's a myth. But if somebody's not following a plan, if somebody's not following rules that they can do on a consistent basis with every single trade, then that is gambling. There are a lot of people who gamble because they have no idea what they're doing. How many of you have been in that boat at some point in time in your trading career? I'm raising my hand. When I first started trading, I had no rules. I had no idea. I just like, hey, here's some stock. I'm going to throw money in these things. And that didn't turn out all that well. Okay. Right. So how about paying a professional is better than making your own investment decisions? How many of you are here because your professional money manager did you such a fantastic job? Okay. Now I can make fun of this because again, I was a professional broker. Now it's not that they're trying to do it on purpose. Okay. I mean, a lot of them have their good intents and good thought processes and good hearts and things along that line. But you know what? If they have a book of clients at 300, 400, 500 or more, how much time are they going to be able to spend on you? Okay. All right. Investing on your own increases your risk. Well, again, this is kind of tied back to number 2. If you don't have any plans and things that you are using for every single trade to help you find the best opportunities, then yeah, it does increase risk because you go back to gambling. Investing is as simple as knowing which stock to buy. Ah, how many of you have wish this was true, right? Knowing which stock to buy. It's simple if you know which stock to buy. Well, you have to wade through a bunch of things to be able to find something that you feel comfortable in going ahead and buying. Okay. It's not that simple. There's things that we need to do. You need to be intellectually gifted to do your own investing. Nope, you don't need to be a trading savant to do it. Okay, you just it's education. Education is what allows you to become gifted to do your own investing. Gil, knowledge, planning, analysis, discipline, and hard work. That would leave me out. Yeah, if that was had to have a license to go ahead and do trading, I would be left out there as well. All right. So something else that is part of the behavioral pillar that does play a factor into us is that there are too many confusing ideas. Okay? Too many confusing ideas. Okay, what are some of these confusing ideas? Well, efficient market hypothesis. Now, these are actually trading strategies and things that people will use, right? Efficient markets hypothesis, 50% principal, greater fool theory, odd lot theory, prospect theory, loss aversion theory, rational expectations theory, short interest theory, random walk theory. Okay. I mean, this is just a handful of things that people will hear about or try to implement and use in their trading in some way, shape, or form. Now, folks, you know me, especially you veterans, know that I go by the KISS principle with trading. Okay, keep it simple, students. Okay, I don't go. I told my boys growing up we don't use the stupid word. So it's keep it simple, students. We need to make sure that we're not letting all of these great things, right? Building a better mousetrap, inventing of the wheel when it's already invented, to get in our way of what we are trying to do. So, folks, remember when I said a little bit earlier, I was on the boat where I was when I first started trading years and years ago, 20 some odd years ago. And so I started up here, knew nothing, right? And my results weren't that great. And then I started to get a little bit more knowledge based off of because, well, I wasn't doing as well as I had hoped it would. And I got to this point where I knew a lot, right? I did a lot of studying. I had to get license for my job as far as learning things about the market and learning about a lot of things. So I had now all this knowledge. I was a 180-degree difference from when I first started out in trading. And what happened here at this point in time, I tried to use all of these different things that I knew and I understood and tried to put it all together. But how many folks, I know you've heard this, right? How many of you kind of understand the whole too many cooks in the kitchen theory? Right? You get too many cooks in the kitchen and it just kind of bogs stuff down because everybody's trying to do their own little thing in the kitchen and all these little things maybe don't agree and come together like you were hoping it would. Okay? Too many cooks in the kitchen. So when I was completely 180-degree different from when I started, again, I was doing a little bit better, but maybe I wasn't doing as well as I wanted to because a lot of the things I was trying to implement didn't work well together. So then what happened? As I started to learn more and become more comfortable with things, then I kind of came back to the decision that I didn't need all of these confusing things and trying to look at all these different things to help me feel better or be more successful in my trading. Okay. Keep it simple. Now, it doesn't mean that I've ignored all the stuff that I've learned. No, it's good information. All knowledge is good for you, but again, all knowledge doesn't work well together. Sometimes it conflicts. I like what Jim just said. He was actually a financial advisor to companies I work for, mostly top marketing and sales using their planning models. I didn't know what I didn't know until taking these classes. And that's a lot of, I appreciate that, Jim, because I was in the same boat. I was in the same situation when I first started my career in the market. All right. So there we go. Too many confusing ideas. Now let's get moving on. Trading psychology. Okay, understanding how you are likely to react in different trading circumstances and situations. Okay, is it the FOMOs? Or is it the fear of missing out? Or has the stock moved too much and you're afraid that as soon as you get into it, it's going to come crashing back down the other direction? So you need to understand your reaction, your behavioral inclination to that. But now, again, understanding if we have rules and things that we want to follow, that we can be consistent in every single trade, our reaction should be very consistent and very different from other people. Okay. Many traders, especially new traders, don't understand how important or the effect of their own psychology on their trading. This is the whole point of what we're going to be doing here. Okay. And helping you get a little bit better feel for who you are. Now, again, it is not something that you'll just say, okay, this is what I'm going to do. Boom, it is. You will evolve as you get more knowledge. You will evolve as you get more practice and insight to who you are and what you like to do and your own risk tolerance. Okay. 10 of the most common trading mistakes are attributed to an individual's trading psychology. Kind of got going back to the picture, right? Our brain is putting into things that we're seeing and taking a peek at. Okay, most unsuccessful traders blame market conditions, market makers, or bad luck for their trading ineptness. How many of you have actually, at some point in time, said one of those, or maybe all of those, all three of those? Market conditions, market makers, bad luck. It's someone else's fault. It's not my fault. Oh boy, we can see that in just life in general nowadays with all aspects, right? It's never my fault. It almost sounds like a politician. Well, it's my fault. It's the other side's fault type of a thing, right? Okay. Well, in reality, it's not, because a market condition. It's not because of market makers. It's not because bad luck. It's because you're trying to do things that you're not comfortable with. You're trying to do things that you don't have rules for. Okay. Now, the moon was in the wrong place, Stephen. You know what? There's it's actually, there are people who do trade, believe it or not, based off of astrological events. Serious. So I know you probably were typing that in as a joke, but there are people who do that. Okay. All righty. But again, all of this we just talked about are emotions. Steve says, I worked in an ER, and the things I saw during a full moon, yes, that does bring out some kind of weird things in people. Yes. All righty. So what are these 10 common mistakes? Really quick here. Trading without a plan. I know you've all heard this. If you fail to plan, you plan to fail. So what is it that we are trying to do through this education, folks? You know, we're not here saying, okay, buy this stock, look at this is what you should do. The part of the purpose of the education is to help you think. My goal in every single one of my classes is to help you think, not help you be a lemming and just follow, right? You need to make sure that whatever it is you're doing, you have a plan. It's a plan built for you specifically that you feel comfortable with, because if you don't have that plan, if you fail to plan, you will plan to fail. Okay. If you followed your trading plan and lost, was it a successful trade? And this is a question I'm asking you, folks. If you had your plan and you end up losing money, was it a successful trade? And I know I'm not fooling any of you veterans here, but it is a successful trade, because hopefully part of your plan was to let you know and be able to figure out how much money you were willing to risk on that trade. Every single trade. How much money were you willing to risk? So if you followed your plan and you lost money because you lost just what you were willing to lose and not more, that's a successful trade. You don't have to like it. I don't like to lose, but I know that I lost what I was willing to lose, regardless of what happens after. Okay. Remember, hopium is not a trading plan. Don't get into this hopium. It's not a trading plan. Okay, what's the other common mistake? Not following your plan. If you have one and you don't follow it, well, it just might as well be number one. You don't have a plan. So don't go to the work of through the process and the steps and just showing, hey, I've got a plan here. But if you don't follow it, then either number one, your rules suck. Okay, so you don't want to follow it. That was a little harsh, wasn't it? Sorry. Or you don't believe in the rules. And so again, it's just like you don't have a plan. Okay, you're setting unrealistic expectations. Okay, so folks, let me ask you this: why did you get involved in the market in the first place? And Gil, I like that. Most important question in placing a trade: how much money am I willing to lose? It's exactly right. All great investors focus on how much they will lose, not how much they will make. But how much? Why did you get involved in the markets? How many of you got involved in the markets because this is you? You know, you're just looking at this, and he says, "Hell, free money, man! There's just dollar signs all over the place. It's raining money, and I can fill up my swimming pool and just swim in money. And look at this." Okay, you hopefully you're getting in with the right expectations. Right, one trade's not going to allow you to go and buy an island in the Caribbean somewhere. And if it did, fantastic. But again, maybe that was luck involved with that. So don't set unrealistic expectations. You're getting in and putting realistic expectations. Not get so crazy with things. Trading against the trend. This is a common one, right? What happens? Somebody what this is. It's a salmon, right? And what's the thing with the salmons? They will always go back upstream to spawn where they were spawned. Okay, they go upstream and they have all these hurdles, whether it's these waterfalls, little tiny things in the stream. Maybe there's not a whole lot of water in the river. They just put forth the valiant effort, swimming. They got to get back to their spawning grounds, right? They're going against the stream. They're going against the direction that river is heading. And it's valiant. There's some things in their way. It might be man-made. It might be natural things that are in their way. And they're jumping up these big old waterfalls and doing it. You see these fishes all the time, these salmon all the time. Maybe have to take a couple running leaps to get up on some of these bigger waterfalls and jump up on there. Some of them are successful. Some of them are not successful. But what eventually will happen to a lot of them? Swimming against the trend. Oops. Okay, a bear buffet, summer dinner. Okay, so you saying, okay, maybe there's one bear and there's 5,000 salmon. Well, the odds are still pretty good in my favor if I swim against the trend. Well, a lot of times there's more than just one bear. Okay, a lot of times there's just more than one bear. So common mistake. Don't get into this trading against the trend because you're expecting it to do something just because you got into it. Next one, proper position sizing. Oh, this trade's the winner. I'm going to get into it because this was going to make me $1 billion and I can go buy my island somewhere. Okay, this is one of the things that Charles talks about all the time, right? With equal amounts into your trades on things that are meeting the requirements and rules that you do have. Don't let that emotion dictate what you're doing. Poor risk management. Okay, yeah, all right. What does this do? Market. I buy a stock that's looking like this, it goes up, and then it comes down. And now maybe we start to lose some money, and then and you say, oh, okay, well, I was willing to lose because we have to be willing to lose money in order to make money. It's going to go back up. And then it starts to go back up and we say, woohoo, we let's just say we got in right here. Okay, we got in right here. It starts to go back up and you say, okay, good, it's going back up. And it might get back up to there and then turns and comes back down. Then you start to lose more money. Okay. And then you say, well, if it gets back up to the price that I got in at, then I'll get out of my trade. I'll exit my trade. I'll just break even and I'll be done with it and I'll be happy. So that's what you're shooting for now, right? Your thoughts of, maybe you have a little bit of thought right here of making some money, but now your thoughts are just trying to get back to breaking even. Okay. Then you come back up here and now the stock gets here and you're getting hopeful that it's going to get back to break even, and it doesn't. It comes back down like this. Now, what do you say? Well, if it gets back up here, then I'll exit. Okay. Comes down some more and it does this. Oh, well, and I'll get out if it gets back up to there. Now, some people will say, I'm just now a long-term trader. I'm just a long-term trader now. I really wasn't planning on getting out of this thing, regardless of how much money I lost. I'm a long-time trader. And so eventually, right, this thing's going to go, eventually it's going to come back up at least here and start to make me money. But how long? That could take weeks. It could take months. It might even take years. And so what good is your money tied up for years just trying to get back to a break-even point, let alone a profit? Okay. This is why poor risk management is one of the biggest things that will bite you in the, well, with the bear. Okay. It'll bite you in the rear end. Successful investors in the market know how much they will lose, and when they hit that, they exit. Okay. When they hit it, they exit. Don't turn yourself into a long-term trader now because you didn't follow rules or have rules in there. Because if we take a look at this, okay, if you lost 10%, that means in order for you to just get back to break even, you need to make 11%. Yeah, you say, well, okay, that's not that hard. Okay, that's not that big of a deal. Folks, what's the average return for a year on the market? Do you know what the average return on the market is for a year? Gil says 7%. Yeah, numbers will vary a little bit, but 7 to 12%. Okay, 8%. So somewhere in that ballpark. So if you lost 10%, you would need to see the market return for the year just to get back to break even on that position. If you lost 20%, you need to make 25% just to break even. How many of you be thrilled if your account just made 25% and you were profitable 25%, but now it has to come back 25% just to break even? Okay, 30%, you need to make 43% to make up for that loss. 40%, you have to make 67% just to break even. If you lost 50%, you need to make 100% to break even. I mean, think about this, folks. How many of you would rather have your money trying to reach some of these break-even returns on profitable positions instead of trying to will a losing position back to just what you paid for it? Okay, let's take this further. 60%, you have to have a 150% return. 70% loss, you have to have a 233% return. 80% loss, you have to have a 400% return. 90%, you have to have a 900% return. Who thinks that's doable? Who thinks it's doable to have a 900% return? I mean, if it was me, I would love to have a 900% return, but not on a position that I'm trying to get back to break even. So folks, this is why you need to understand how much you're willing to lose on your trade in order to give you a reasonable expectation to make that back. Okay. And how long? There's a time factor in here. So if you lost 40% and it takes 67% to recover, how long? 3 months, 6 months, a year, or longer? Allowing that money to really not work for you. It's trying to scratch back. Okay. So you have to come up with something that is comfortable for you, regardless of the strategy that you're trying to employ. Because what happens if you lose 100%, then you're not playing anymore. You're not trading anymore. You're not having fun. Well, you probably wouldn't be having fun if you were losing 30, 40, 50% or more, but you're not having fun. Renee, what percent is reasonable for you? Everybody will be different. Everybody, and it also depends on this type of strategy. Because every strategy you might be willing to risk more or less. Shorter term trades, you probably will be risking less. Longer term trades, you'll probably be risking more in those scenarios. But folks, you know what? If I'm getting into the 30, 40, 50%, yeah, I'm not following my rules. Okay. Impatience leading to over trading, right? They're kind of going back to, what is it you're really trying to do? Is it plans? So you don't have a plan, or maybe your rules are causing you to be too impatient. You're over trading. There's a saying in the market. I love this saying, folks. The fear of missing out. Okay, there's that. But I love this saying that I'm going to pop up here. The market is a device for transferring money from the impatient to the patient. Now, some folks might be saying, well, doesn't that just kind of contradict what you just said on the poor risk management and making sure you're getting out, not losing too much? No, it's not. But we're not getting out if one day the stock decides to go down. We're not getting out if one day the stock goes up and we're happy that we made some money. We have to be patient following our plans for that particular type of a trade. So if you're just kind of doing helter-skelter, kind of trying to go with whichever way the wind's blowing and you think it's blowing, yeah, you're just kind of falling into the impatient and just transferring the money to somebody who has a little bit more patience in there. Now, the 8th, cutting profits short, letting losers run. Okay, how many of you have heard you can't lose by taking a profit? How many of you believe you can't lose on a trade if you take a profit? Overall, so you have a plan, you're trading a plan, you get out, take a profit, you can't lose, right? It's not. Yeah, that's a situation where you will always make money. Okay. Now, see, some of you are starting to think about this a little bit, but this is actually wrong. Okay. I've told the story before, and I'll tell it really quick. Other company that I was working for, where we actually had classes and taught classes in live, and had groups of people would come and attend the classes in person. We're kind of going over this and talking about not cutting the profits short or letting the losers run and these types of things, and we're talking about percentages, right? And sometimes people get too caught up on percentages. Oh, I win 80% of the time. I win 60% of the time. I think that the higher winning percentage is a better formula for you having success in the market. Okay. And some of you might have thought about this as well, or think this as well. But again, winning percentage, as far as number of trades that you're winning versus number of trades that you are losing, is not a formula to be successful in trading in the market. Okay. I am more focused on how much money I make compared to how much money I lose on my winners compared to my losers. And again, back when I was teaching the intermediate advanced classes, a lot of you older folks here, older students, no, I did kind of a series of trading plans and back testing, and talked about the importance of expectations. Okay. You can really have it set up where percentage wise, you're losing more times than you're winning, right? Lose 4 out of 10 trades, win 4 out of 10 trades, win 3 out of 10 trades, and your plans can still make you money in the market. Okay. But going back to this situation, where this class, we're talking about this and percentages and winning percentages and things along that line. And if I had a lady that was sitting in the front row, had just who said, "Wow, I win 80% of my trades." And I said, "Wow, that's pretty good. You must be very successful." And then a couple minutes later, we wrapped up and went to lunch. Right, had a break or something. And so she was still sitting right there, and I walked over and I said, "Wow, you must have some pretty good plans. Your account must be growing really well." We're just kind of talking one-on-one now. And she said, "No, I lose money overall." Okay, I lose money overall because she couldn't stand really taking a loss. That she hangs on to those losers forever and ever and ever. And then finally, when it gets back to just making a profit, she gets out of it. As soon as it's profitable, even by a couple of dollars, she gets out of it. So you can lose by taking a profit if your profit isn't big enough to offset losses that you're taking. And this is why you need to have good trading plans. Now, on the flip side, folks, if you're losing on a trade, it's not a loss until you close it out. Now, I don't have this up on the slide, but I'm just throwing this next one in here. If you have a losing trade and you don't get out of the trade, it's not really a loss. It's not a loss until you sell. How many of you believe that? And I know there will be some differing opinions on this, because if you're talking about just, for IRS purposes and things along that line, it's not a loss until you close it out for tax purposes, right? It's not. That's what it is. It's a loss. You've sealed that loss. You've basically locked in that loss, folks. It's still a loss whether you sell it or not. If you're hanging on to it, that position lost 20%, 30%, 40%. Your account is still down that 20%, 30%, 40%. It's a loss. You can spin it whatever way you want. It's still a loss. Okay. Now, if you wanted to go into, I'm a long-term investor thought process because of it, you certainly can, but it's still a loss. Your account is down. You're liquidating positions now. The liquidating value of your account is down. That's still a loss. Okay. So it's your account is still down that money. Afraid to lose money. Folks, don't be afraid to lose money. You have to be willing to lose money in order to make money. Otherwise, you start to fall back into, this situation. this situation, this situation. Okay. You start to do other things that are mistakes. You're just compounding those mistakes, right? Everybody expects it to go up. As soon as it turns back around, we don't want to panic. And then you want to focus on being right. No, you can't be right all the time. You will be wrong. Regardless if everything sets up like it should on your trade, meeting your rules and things like that, you will still lose. So don't focus on that. You have to be right. This was one of my mistakes when I first started trading. I'm very competitive, folks. Very competitive with everything that I do. Okay. I hate to lose in everything. And I took that into the market. I hated to lose. It was either they were right or I was right. Kind of looking at the smaller picture instead of the bigger picture. And if I was losing, I was going to show that stupid stock and that company that I was the right one. So don't do that. Follow the rules. Okay. Now, just really quick, some other ones. There's only one guarantee in the market. You will have losing trades. That's the only guarantee. No way around that. People become emotional because it's their hard-earned money. Right? You folks, you're trading your money. If you see it being taken away from you, it's an emotional thing. Okay. What's the ultimate scorecard? Kind of talked about this. Is it the number of winning trades versus losing trades? Or is it the percent of winning trades versus losing trades? Or is it the value of your account growing or decreasing? Well, I'd say it's probably that latter one. That's the ultimate scorecard. Is the account growing in value or is it decreasing in value? Regardless of the percentage of your winners versus losers, anything along that line. Bottom line, are your rules set up in place to allow you to do that? Don't focus on the wrong things. And be careful of hindsight trading. Okay, folks? Hindsight trading is, well, this happened once when I was in the trade, so I'm going to change all my rules because that happened once in my trade on a trade I did. That's hindsight trading. Okay. Now, if you are in the process and you say, okay, well, that same thing happened on multiple trades, like the majority of my trades, 51% of my trades, then that's where you start to now see you make some changes, not because of one event, because our rules will not sit there and allow us to be profitable every single trade we're in. We cannot take into account events that are irregular events that don't normally happen, but we do have rules that if they do happen, we're still fine overall. And Steve, that's not backtesting, hindsight trading, correct? Okay. Other ones really, oh, whoops, I think I doubled up on that slide. Oh, okay. Only one guarantee in the market, you'll have losing trades. You can have multiple losing trades even with good rules. So we're going with the coin toss here to drive this point home, right? How many times we flip a coin? So we're going to have a toss, the odds of heads or heads or the tails and the results. So let's just say we flip the coin, and it's not a two-headed coin. It's a coin that has a head and it has a tails. So what are the odds that on this first toss that it will come up heads? First toss. This one's probably the easiest one, right? It's 50%. First toss, odds of it being heads or tails is 50%. Easy. But let's just say that on our first toss, it came up tails. It didn't come up heads. It came up tails. So on that 50-50 odd that we had, it went against us. What about our second toss? What are the odds now that second toss, it comes up heads? 50%. Why? Well, because does the coin remember the previous toss? Does the coin keep track of how many times it came up heads and how many times it came up tails? Bob says yes. You would think so, right? They have the little microchips in there. But no, but even if it did come up heads, our third toss, odds are not changing because it's a dumb object. A coin doesn't have a brain. The odds, unless you have something that's has a flaw in it that'll favor one side over the other, it's still a 50% chance that it'll be heads. No, regardless of how many times you flip that, how many times it comes up either heads or tails, the odds will never change. This is one of the mistakes that people make in the market. I've had too many losing trades. This next one has to be a winner. Each and every trade is a separate trade. The market is not looking at you and saying, okay, well, Gil had 4 losing trades in a row. We better make this one a winner for him. No, it doesn't work. Each trade is its own separate event, and it works or doesn't work based off of the situations and scenarios at that point in time. Okay? So don't get caught up. Oh, I've had so many losing trades in a row. This one has to be the winner. Then what happens? Then people start to gamble and they start to do different things with their position sizing. Or I've had a couple winning trades in a row. This one's probably going to be a loser. I'm not going to take such a big position. Well, if you think it's going to be a loser right off the start, then why are you getting into it? If it meets your rules, meets your criteria, don't have a fear of getting into your trade. Okay. You don't have to beat the stock. That kind of goes back to that can't lose mentality. Folks, if you don't know this by now, I'm going to be a little harsh. Market doesn't care what you think. This is a hard thing for some people, but the market doesn't care what you think. So this is why some of those things, right? Trying to swim against the stream, the trend, doing things based off of your own perception, kind of going into that little game that we played earlier. Doesn't care what you think. It's harsh, but it doesn't. I learned this real early in my trading career. Okay. But this is big. Emotional traders are unhappy traders. Bottom line. If you're an emotional trader, you will be an unhappy trader because you will have such the roller coaster of emotions from one day to the next, even on the same day, just depending on what your trades are doing. Now, it doesn't mean we're emotional creatures by nature, folks. We are human beings. We're emotional creatures by nature. So sometimes it is a little bit hard to harness that emotion and not allow it to creep into our decision making. And this is for everything in life, just not for trading, right? If we tend to make decisions based off of emotion in our everyday lives, yeah, the things probably won't turn out quite as we hoped all the time. But it is hard to, especially starting out, and even for people who've been trading for a long time, sometimes it's hard not to allow those emotions to make decisions for you. But that's one of the reasons why we have rules. You come up and create the rules that you feel comfortable with to allow you to take as much emotion out of it. And folks, I've seen this. I really have in person, not only in my own life, but I used to work with a person that you could tell the type of day he was having in the market just by looking at him. If he was winning, he was one of those happy-go-lucky guys who would walk around the office, slap everybody on the back, calling everybody buddy. How's it going, buddy? Right? He's best friends with everybody. And when he was having a bad day in the market, it literally he sat at his desk, kind of like shoulders hunched over. And seriously, right? You've seen the cartoons with the person who's like in a bad mood or happy. They have the cloud over their head. I swear I could see that cloud over him because he wouldn't talk to anybody. Bad day. Unhappy traders end up quitting. I don't want you to quit. We don't want you to quit. We want you to do this as long as you want until you're just sick and tired of trading because you don't want to do it anymore. But you're not quitting because you're unhappy. You're just quitting because, hey, you know what? Don't want to do it anymore. But I hope that doesn't happen. Hope you will trade till the end of your days because it's fun. Even though that's an emotion, but it's fun. You want to do things that are fun, but you keep it fun even on the downsides of it. Okay, so that was a lot of stuff, right? Again, kind of a little bit different type of a class because in order to help you understand who you are in real life will translate over to your trading. So if you are aggressive by nature in your trading, you will be probably more aggressive. I mean, aggressive in your life, you'll probably be more aggressive in your trading. If you're more conservative in your life, you'll probably be more conservative in your trading. Now that can change because what you might think is conservative well, actually what you might think is aggressive when you first start, as you get more knowledge, may not be as aggressive as you thought. So you will evolve, you will change, and your behavioral pillar will evolve with you. Okay. So folks, helpful? This is helping you see now how we are not now letting perceptions dictate what we're doing. You know, LIN, great example, perception, thought process, didn't pan out. Okay, regardless, let me switch the gadget here, go back, I'm gonna go to news and bring the news up. Again, regardless of what the news says, your interpretation of the news may not be what the news is really projecting. So the clues, the processes, and the things that you think you are seeing on the screen, just like that game, what do you see? You see one thing that might not really be what it is. So we need to come up with our own behavioral pillar and see what the actual market behavioral pillar is thinking about the news. Okay? Market doesn't care what you think. Market doesn't care what your brain is filling in if the market doesn't see what your brain is filling in the blanks, focusing on those points that you see. Now, again, we do want to see stocks going in the directions that we want. It makes it a whole lot easier. Okay? Bring up a stock, AKAM. Right off the bat, we can see this is a bullish stock. But what kind of things might people be looking at now? Oh, it's too high. It's too high. So now what does our brain start to think? I can't go any higher. I can't get into it right now. And it doesn't matter if it's at a 6-month high, a 52-week high, a 2-year high, a 5-year high, or an all-time high. Your brain is now going to start to think and give you doubts. Oh, I can't go any higher. Just like the brain will give you encouragement of a stock that's going down and says it can't go any lower. Sometimes our brain is our worst enemy, but that's tying it in with the emotional side of it. So how many of you look at this stock and say, "Holy cow, I like the looks of that stock"? We're just talking technically here, okay? How many of you look at this stock technically on the chart and say, "Man, I love what I see here. I love the direction that it's heading. I love, I wouldn't mind owning this stock." Again, just technically, not talking about some other things, okay? And how many of you are looking at the stock saying, "Eek, I don't think I'd get into it now. It's too high." And don't be hesitant, don't be bashful, and think that that you'll be giving the wrong answer, okay? Even though you are. No, I'm just kidding. You're not. Okay, sell, 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 says JBS. Going on. Is that a quote from Trading Places? Sell, sell, sell. Turn those machines back on. Okay. Anyway, so again, we all look at the stock. Our brain starts filling in things based off of our behavioral patterns. Okay. So what about the fundamentals? I don't know. What did we even talk about? What happens if you wanted to do a short-term swing trade on this? Would fundamentals be that necessary? No. I mean, you still look at the fundamentals. Why don't I'll pull it up? I'm not going to be a fundamental poo-pooer on this one. Okay, so let's bring it up. I'll go to Yahoo Finance. So that is a technical term, by the way. Financial poo or fundamental poo-pooer. Okay. We'll pull this up. Okay, it's making money. Trailing 12 months, EPS 331. We'll go to the analysis tab. We'll bring this up. We'll scroll down. Earnings history. Positive beat, positive beat, positive beat, positive beat. That's a 4 out of 4. Most recent quarter, higher than the previous quarter. That's a yes. And then analyst revisions goes from 592 to 610, but more importantly, next year goes from 642 up to 675. So that's a 4 yes, yes. Can you get better than that? Not a quick fundamental analysis? No, you can't. Well, I guess you can say it goes from 642 to 1,000. Well, that's, I guess, could be better. But realistically, right? It's perfect score for YY. Okay. Is the moral, Randy asks, is the moral of the story, have a plan to change your mind about what you are seeing in any individual stock? Have a plan to see if the stock that you're, okay, I like that, but I'm going to change it a little bit. Moral of the story is you have a plan that when you look at a stock, you will see if it meets criteria that you personally have to do a trade or not. Okay. Moral of the story, have a plan, a set of rules that you will follow every single time you look at a stock. Then determine if that stock meets the requirements for your plan. If it does, don't hesitate to make your trade. If it doesn't, then you have to either make a decision to not do the trade or make a conscious decision to break your rules to trade it. Okay. So Gil says, look at a 10-year chart. Okay. How about if I just do this? I go 10-year weekly so we can see the whole thing on one screen here. There's a 10-year weekly, right? It's coming up on its kind of resistance level, about 120. Okay. Some of you might say, well, it's at 116 right now. I might wait for that to break through before I do something. Sure. Might feel a little bit more comfortable. But what about for buy and hold? What about buy and hold? Entry that important? Steve, need to check fundamentals. We already did that, right? Entry doesn't matter. I still like to see, some things going in my favor as far as the entry, as far as the bullish. So if I'm looking at this back on the 1-year chart, do we kind of see it bouncing up off a support level? Do we see the stock? I'll zoom in. Is it bouncing up off a support level? I see it bouncing off a support level. Where's that support level? It's about 114. Yep. Put this one right about here. Isn't that a support level it's bouncing up off of, folks? It is. I like that. That's a hold. Yep. Bounce up off support, close above the high low day, which was yesterday. I'll zoom in a little bit closer so we can see that. This was the low day. It closed above it yesterday. So technically, that's our entry. If you wanted to do a trend trade on it, 50-day moving average, there you go. Pop up all the moving averages, the 20, the 50, the 200. It's above all the moving averages. Looks pretty good. I don't know. What do you think? Should we do a trade on it? I'm going to do a trade on it in our class because it meets criteria. I'm not kidding. This is not a buyer's recommendation to do anything, but it meets criteria. We're taking emotions out of it. We're getting into it. Okay, so I'm going to go ahead, click on the trade tab. Click on the ask price here. Now, obviously, if we're using 5% of our overall portfolio, we're not going to buy 100 shares because that would basically take about $11,600. So how many shares could we purchase? Now, one thing that the paper trading isn't doing right now is allowing us to put in a dollar amount. So we'll have to calculate this. So all we do is we take how much money? $5,000. If we're doing the 5%, we'll divide that by the current price of the stock, 116.02, comes up to 43 shares. Steve had that typed in already. Good job, Steve. So all we'll do is we'll just type, we'll change this to 42. No, 43, excuse me. Yeah, put that one, yeah, 43 shares. There we go. Fat fingered it. Now, since the market is open, it's between the hours of 9:30 a.m. and 4 p.m. Eastern time. We could change this to market instead, and then we'll just confirm this. Now, again, part of our lesson was to make sure that our brain does not fill in anything that we expect to see there. So we're going to read this out loud. We're buying 43 shares of AKAM at the market to open. Okay. Does that, did our brain fill in any blanks, or is that the order that we want to see? Well, that's the order that we want to see, correct? I'm just going to put in our notes here. Trade in begin intermediate class on 12. What's today's date? 13/23. good fundamentals, and I'm going to put trend trade on here. Bounce up, off, support. And then I'm not putting any target. I don't usually put targets in, no target on here. Okay. So that looks good. I'll go ahead and send this off. We got filled. Now, the only thing that we would need to do at this point in time is we would put a stop on just in case it decides to go against us. How much money are we willing to risk on the trade? So with this being a trend trade, I would be willing to risk 5% below support. You might have a different number, but in this type of a trade, a trend trade, I would be willing to risk or lose 5% below support. It's not 5% from where the current price of the stock is, because we still want to use the technical aspects of what we're seeing on the chart to help us identify if that technical barrier is broken, that I still want to give it a little breathing room before it stops me out. Okay, so what we would do here is we would take the current level of that support of 114 and we'll times that. If I'm 5%, I'll times that by 0.95. And it's 108.30. Okay. So I'm putting it 5% below support, and the support level is 114. Now it came up 114.07 because I couldn't get directly on, but 114 is the support. So I take 114 and times it by 0.95 for 5%, it comes up to 108.30. Okay, so let's put this stop on. Go back to the monitor page, and what did we just trade? AKAM. Oh, look at that, we're losing money. That was a dumb idea. Good grief. No, I did a right click on the symbol. Great closing order with stop, and it was my dumb idea, so I get to take the blame. So we have our trade selling the 43 shares with a stop here, folks, and I'm going to change the value of 108.30, and we'll change the time in force from a day to a GTC. And if you wanted to do 108, you certainly could do 108 as well. Up to you, but I just did the exact 5% below. So 108.30, there we go. We'll confirm this, and we will sell AKM with a stop of 108.30. GTC good to close. Looks good. We'll send that off. Now, if we go back to the chart, there's our stop. Now, interestingly enough, where does that stop kind of line up? Anything else you see on the chart? An old resistance level, huh? Maybe just a little bit below that. So breaking down through that and maybe have to violate that resistance level, which would be a support level, before it gets stopped out. Now that's pretty cool, isn't it? All right. So there we go. I know we've talked about a lot today. I know that sometimes when we try to figure out our behavioral analysis, it is a process. It's not something that you're just going to change immediately right after class is done, and that's how you're going to do it. That's how you will do it. No, it will be a process. You have to figure out who you are. You have to figure out your emotional traps so you can create plans that will keep you from falling into those emotional traps. So your behavioral pillar is exactly for you. It's not for other people, because you will have very distinct plans and rules and emotions that other people will not have. So very important for you to go ahead and make sure that you don't turn into an emotional trader, because I do not want you to be unhappy. All right. Helpful, folks. I know it's kind of a little bit different type of a class today. A lot of slides, a lot of thinking. But again, that's my whole point. I want you to think. I want you to become aware. I want you to understand who you are. Because if you don't know who you are, your trading will be lucky if you're successful. I want you to be successful. I want your trading to not be successful because you're lucky, but I want your trading to be successful because you've created a plan for you. Okay? So wrapping this up, folks, again, if you have any other questions about this or other things, you can certainly come to the Q&As and get those classes or questions answered. You can email us at the EDU support specifically for questions like that as well. But thanks, folks. I appreciate you joining me with this. But again, just kind of the wrap up here. Understand the myths of self-directing. They're wrong. Create and follow your rules so you don't trade with hopium. Control your emotions so you can enjoy investing. Apply the KIDS principle. Practice trades in the paper trading account, and make sure you come to class next week. It will be our final class in this series of classes before the end of the year for the quarter, and then we'll change instructors on that. But thank you so much for joining me and bearing with me today. I look forward to seeing all of you next Wednesday. It's hard to believe that that'll be the week before Christmas. Holy cow. But that's what will happen. All right, everybody, take care. I look forward to seeing you in classes throughout the rest of the week here. Bye-bye.